In 37 days, my first ever dividend payment lands in my account, £7.36. It is not a lot, but it is the first time in my life that a company I own a piece of has paid me real cash, just for holding their shares. And while I wait for that money to arrive, I have just made my month 2 move. But here is what surprised me about month 1. Legal & General's dividend yield is actually higher today than it was the day I bought the shares. That should not really happen if my investment was working, so let me show you the numbers. Quick one before we go any further. This is not investment advice. I am documenting my own investing journey. Always do your own research before putting money into the stock market. So where do we stand after the first month? 2 stocks, £200 invested, 120 into Legal & General, 80 into Aviva. The plan was always simple. 200 a month into UK dividend stocks, every single month, watching the snowball start to roll. Month 1 is in the books. And here is the result. £200 invested. Current portfolio value £204.55. A gain of £4.55 or 2.3% in roughly 30 days. I want to be honest about that number. £4.55 is not life-changing. You could not buy a coffee with it in central London. But this is exactly what investing for dividends looks like in the early days. Slow, steady, quiet. The interesting bit is how that gain is split. Aviva is the early winner, up £4.59 on an £80 investment. That is plus 5.7% in a single month. Legal & General is essentially flat, down 5 pence. 5 pence on a £120 holding is a rounding error. Effectively, Legal & General has gone nowhere. And that brings me to the surprise. When I bought Legal & General, the dividend yield was around 8.5%. That number was a big part of why I bought it. The yield today is 8.67%. It has actually drifted upward. This is one of those things that confuses people who are new to dividend investing. If a stock's price stays flat but the yield goes up, it usually means the company has either announced or just paid out a slightly bigger dividend. In Legal & General's case, the recent ex-dividend date confirmed the final payment of 15.67 pence per share. That locks in the higher yield until something changes. So even though the share price is dead flat, the income I'm about to receive is slightly bigger than it looked 4 weeks ago. That is the difference between price and income. The share price is what other people will pay you for the stock today. The yield is what the company is actually paying you to hold it. They move independently. And right now, mine is moving in the right direction. Think of it like a savings bond on the high street. If you bought a 5% bond for £100, you would get £5 a year in interest. But imagine the next day someone offers to buy that bond off you for £95. The new buyer still gets £5 a year, but on a £95 investment. That is more than 5%. The bond itself did not change. The price someone paid for it did. That is exactly what is happening with Legal & General. The company is paying me the same dividend per share either way. The flat share price just means the percentage looks slightly better than it did when I bought. Quick one, if you want to see what £7.36 actually turns into when you reinvest every single dividend for the next 12 months and 24 after that, subscribe. I'm going to track every payment, every reinvested share and every penny of income in real time. There are no other channels following an actual UK dividend portfolio month by month from the very start. This is it. Now back to the countdown. 37 days. That is the gap between today and the 4th of June, when the Legal & General dividend hits the account. £7.36. The exact maths is 47 shares of Legal & General multiplied by 15.67 pence per share final dividend. That works out to £7.36. Now I know what some of you are thinking. £7 is barely worth talking about, and on its own, it is not. But this is the first dividend, the very first one, and every single dividend after this one builds on the last, because every penny gets reinvested into more shares, which pay their own dividends, which buy more shares. And here is what is genuinely interesting about that number. £7.36 is roughly the cost of a sandwich and a coffee in central London. It will not change my life. But it landed in my account because I owned something, not because I traded an hour of my time for it. The shares keep paying me whether I am working, sleeping, or on holiday. That is the thing about dividend income that you cannot really feel until your first payment hits. Once you have actually seen real cash arrive that you did not have to earn through work, the way you think about saving versus investing genuinely changes. That is the moment I am looking forward to. Not the £7 itself, but what it represents. This is the moment the snowball actually starts moving. For the first 30 days, I have been buying shares with cash. From June onwards, those shares start buying themselves. That is the entire game. Get the snowball moving, then get out of its way and let it roll. Let me put some real numbers behind this. If I keep investing £200 every month and reinvest every dividend at this same blended yield, by the end of year one, the portfolio is producing roughly £170 a year of income. By year three, around £560 a year. By year five, with reinvestment compounding on top of fresh contributions, it is on track to produce roughly £1,000 a year of income. Not from picking better stocks, not from working harder, just from holding and reinvesting. The first dividend is the smallest one I will ever receive on this journey. Every single one after this gets a little bit bigger. Right, month two. Time for the new money to go to work. The third stock in the portfolio is British American Tobacco, ticker BATS on the London Stock Exchange. And before anyone clicks off, yes, I know exactly how this sounds. Tobacco. In 2026, most modern investors would not touch this with a barge pole, but I want to be transparent about how I actually got here. I had a short list of 5 UK stocks for month 2 before I made this decision. 2 of them I rejected on yield because they were paying below 5% and I wanted something that pulled its weight on income. 1 I rejected on dividend cover because the maths just did not add up. They were paying out more than they were earning. The 4th was in a sector I already had heavy exposure to through Legal and General and Aviva. The one that survived all 4 of my filters was the one I least expected to end up buying. So, before anyone judges this on the obvious surface objections, let me show you the actual numbers behind it. Here is why I am buying anyway. The current share price is around £42.70. The dividend yield is 5.78%. The dividend cover is around 1.5 times, which is healthy. They pay quarterly, not twice a year, so the income arrives more often. And here is the part that really matters for a dividend investor. They are a Dividend Aristocrat. They have raised their dividend every single year for over 25 years. Through recessions, pandemics, regulatory crackdowns, lawsuits, the lot, the dividend has never been cut. I am buying 4 shares at roughly £42.70. That is £170.80 going into British American Tobacco, with around £29 left over from the 200 sitting as cash for next month. 4 shares of British American Tobacco will pay me roughly £9.80 per year in dividends, split into 4 quarterly payments of about £2.45 each. I'm keeping it short on British American Tobacco today because next week's episode is a full deep dive on this exact stock. I will go through the bear case, the ESG concerns, the actual numbers behind why I think this is a smart aristocrat play, and the risks I am taking on. If you only watch one episode in May, make it that one. So here is where the portfolio stands at the end of month 2. 3 stocks, £370, 80 invested across Legal and General, Aviva and British American Tobacco. Around £29 left as cash. Combined annual dividend run rate based on current yields, roughly £26. That is up from £16 last month. £10 more annual income, just from 1 month of buying. And in 37 days, the first £7.36 of that lands in the account. And if I just keep this same plan running for the rest of the tax year, that is another 11 months of £200 contributions on top of these first 2. By April 2027, that is roughly £2,400 total in the portfolio, with an annual income run rate climbing toward £170. That is the trajectory of a slow snowball that has only just started moving. £370 invested, £26 a year of expected income. That is a blended yield of around 7% across the whole portfolio. If I keep this going, £200 a month, every month, reinvesting every dividend, the maths gets very interesting very quickly. But that is a story for the long-term episodes. Month 2 is done. The portfolio has tripled in stock count. The first dividend is 37 days away. And next Friday is the British-American Tobacco Deep Dive, which I'm genuinely excited about because it is the most controversial pick of the journey so far. If you want to follow this from £200 a month all the way to a real dividend income, subscribe. I am posting a new video every week documenting all of it. Now, I want to hear from you. Would you buy a tobacco stock for the dividend, or is it a hard no? Drop it in the comments. I am reading every single one, and the answers genuinely shape what I cover next. Until next time, happy investing.